Welcome back, everyone. Today is Monday, July 20th. We are approaching a notable checkpoint for the equity market, and specifically for the artificial intelligence investment thesis. Wednesday afternoon, we finally hear from Alphabet. Google is stepping up as the very first hyperscaler to report earnings this season, and they are arriving at an interesting AI Capex crossroads.
It is a key reference point for the entire market. Alphabet isn't just another technology company reporting earnings. It is the first large platform to offer fresh evidence on whether the billions of dollars flowing into AI infrastructure are beginning to produce acceptable returns. We have spent weeks watching a steady, persistent rotation under the surface of the market. The working question is whether the AI trade acts as a seesaw. If the technology leaders moderate their infrastructure spending, does that support their own free cash flow while pressing the semiconductor stocks lower? Or, if they continue spending heavily, does that support the chip makers while weighing on software margins? We have three distinct roads we could travel down, and Alphabet will help illuminate the path.
That is right. We are going to unpack those three roads in detail today. But before we get to the Wednesday report, we should look at how the market positioned itself today, as it was a somewhat cautious session overall.
Quick note, this is education and entertainment, not investment advice. Companies are examples. Never buy or sell calls. Do your own research.
Looking at the major indexes, we ended up with a quiet close, but it felt like a significant question was hanging over the trading desks. Every major index finished in the red, though the changes were modest at the surface level.
Yes, the Dow Jones Industrial Average closed down 0.59% at 51,839.26. The S&P 500 slipped 0.19% to finish at 7,443.28. The Nasdaq Composite ended essentially flat, down just 0.05% at 25,508.07. And the Russell 2000 gave back 0.67%, closing at 2,942.43.
Interestingly, the volatility index, the VIX, also fell, dropping 0.64% to close at 18.65. When you read those index numbers aloud, it sounds like a completely standard, uneventful summer Monday.
It does, but those headline numbers cover a bit of underlying tension. All four indexes printed red closes, and we actually saw the market open higher early in the day, only to slowly fade as the session wore on. It was a session where buyers stepped away rather than a session defined by aggressive selling. Investors appear hesitant to adjust positions or commit new capital right before Alphabet reports.
That hesitation was clear when looking under the hood at market breadth. We observed a definite breadth leak today, with broad weakness existing underneath a fairly narrow shelter.
That is an accurate description. If you look at the internals of the S&P 500, we had roughly 2 decliners for every advancer. That is a weak ratio for a day where the headline index only fell a fraction of a percent. Volume was on the lighter side as well. The tape appeared to show capital seeking shelter in larger balance sheets while the broader market weakened. That kind of concentration usually reads as caution rather than broad conviction.
We saw the communications and software sectors catching some of that shelter bid. The XLC Communications ETF closed up 0.14%, and the IGV Software ETF added 0.19%. Meanwhile, cyclical and defensive areas declined.
Indeed, healthcare saw some profit-taking, with the XLV dropping 1.14%. Materials were lower, with the XLB down 0.99%, reflecting some China and cyclical uncertainty. In the industrials and consumer discretionary sectors, the XLI and XLY both shed 0.72%. It was a day of broad weakness where capital huddled in select mega-cap names.
Another factor in today's tape was the geopolitical environment. The energy markets were processing some conflicting headlines out of the Middle East. We had reports that Pakistan and Qatar were floating a 10-day ceasefire proposal.
But the actual events on the ground told a different story. The United States completed a 9th consecutive night of strikes against Iranian targets. At the same time, we saw the Houthis officially announce a maritime embargo targeting Saudi-linked shipping. The ceasefire messages are circulating, but the physical conflict remains active and unresolved.
The commodity markets seem to weight the ongoing conflict more than the proposals. WTI crude oil settled higher at $83.23, up 0.9%. That elevated oil price naturally impacts inflation expectations and the bond market.
Precisely. The bond market is incredibly sensitive to these energy inputs right now. When oil prices remain stubborn, it puts a floor under inflation data, which in turn keeps the 10-year Treasury yield elevated. We saw the 10-year yield rise about 5.7 basis points today, landing at 4.598%. The US dollar index, the DXY, also firmed up, rising 0.24% to roughly 100.99. Meanwhile, gold was roughly flat around $40-20. It creates a complex environment for equities when both oil and yields are climbing. Unsurprisingly, we saw the XLE energy sector rise 0.45% alongside the crude prices.
Taking a quick lap around the global markets, it was a mixed picture overseas. Japan was offline today as the Nikkei was closed for the Marine Day holiday.
However, China had a stronger session. The Hang Seng in Hong Kong advanced 2.36%, and the Shanghai Composite added 0.85%. These moves coincided with ongoing stabilization measures and state support signals in the region, which provided a bid for local equities.
Europe softened during their session. The Stoxx 600 slipped 0.3%, and the FTSE 100 in London fell 0.71%, pressured by some of the commodity and defensive names we discussed earlier.
Then we have the crypto complex, which had a modestly firmer day while equities were cautious. Bitcoin moved up 0.88%. Ethereum outperformed slightly with a 2% gain, and Coinbase followed the crypto equity performance, closing up 2.11%. It was a pocket of relative strength in a quiet global tape.
Let us bring the focus back to the U.S. technology sector, because the way semiconductor and software names behaved on Monday was quite interesting. It complicated the working hypothesis that we are in a simple seesaw rotation, where software and semiconductors move in opposite directions.
Exactly. Monday served as a data point that adds nuance to that idea. We saw Microsoft advance 2.15%, which fits the software rotation narrative. But we also saw Micron Technology rise 1.94%. The semiconductor index, the SOXX, finished in the green by 0.45%, and the SMH was up 0.41%. So, we had certain chips and software rising together, which contradicts the strict seesaw model.
Yet, at the same time, semiconductor equipment makers declined. Lam Research, the LRCX ticker, dropped 2.09%. KLA Corporation, KLAC, fell 2.42%. What do we make of this split within the semiconductor trade itself?
The market appears to be distinguishing between utilized memory and component demand versus new tool and clean room intensity. Investors are treating companies supplying high-bandwidth memory differently than companies providing the machinery needed to construct new fabrication plants. It is a subtle distinction, suggesting that the recent rotation is not a uniform sell-off of all hardware, but rather a more selective adjustment based on specific supply chain roles.
That nuance is important because the headline flow data has been notable. Goldman Sachs Prime Services released an update on hedge fund positioning, illustrating a persistent tech reduction over the last 2 months.
The data is quite clear. According to Goldman, hedge funds have net sold U.S. technology stocks in 6 of the past 8 weeks. We are looking at a cumulative market value reduction of about 10% across their prime brokerage book. This marks the largest 2-month reduction for this specific data series since it began more than a decade ago. It is a significant shift in institutional allocation.
We have to ask neutrally whether this multi-week selling is simply a flow event, or if it represents a fundamental signal about the technology sector's future prospects.
It is a vital question. Currently, this reads as positioning and flow evidence, a rebalancing of portfolios that were heavily overweight semiconductors earlier in the year. The fact that mega caps like Microsoft and Alphabet were catching bids today suggests that capital is not completely leaving the sector. Rather, it is seeking the shelter of larger balance sheets and recurring revenue businesses while reducing exposure to hardware momentum. The capital is rotating, not necessarily vanishing.
That brings us to the fundamental anchor of the week. Alphabet reports on Wednesday after the close. Why is Google serving as such a key reference point right now?
Alphabet is the first hyperscaler to report, making it the initial reference point for the entire earnings season. Before we hear from Microsoft, Meta, or Amazon, Google will offer the first look at current artificial intelligence spending realities. Market participants are looking to them for data on how the infrastructure investments are progressing and whether those investments are aligning with revenue expectations.
And Alphabet stock showed some stability today, closing up 1.52%. They have the opportunity to explain their spending levels and detail what that spending is achieving for their core businesses. The commentary from Alphabet on Wednesday evening will provide a framework for evaluating software multiples and semiconductor valuations in the weeks ahead. Let us explore the mechanics of this AI Capex crossroads. It helps to visualize what is actually happening with all this capital. We are essentially watching these companies construct a new AI highway.
That is a helpful analogy. Think of the capital expenditures, the Capex, as the raw material laying down the lanes of the AI highway. The hyperscalers are investing billions to pave these lanes using GPUs, networking gear, and data centers. They are building the infrastructure required for the next generation of computing.
And the utilization of those data centers, the actual compute tasks being run by developers and enterprise clients, represents the traffic driving on the highway.
Exactly. Laying the lanes requires significant capital up front. But having traffic on the highway does not automatically cover the costs of construction. The cloud revenue, the search advertising premiums, and ultimately the free cash flow represent the tolls. The central focus of the market is the relationship between the cost of paving the lanes and the collection of the tolls. Alphabet is standing at the toll booth on Wednesday, and the market wants to check the math to ensure the tolls can eventually pay for the concrete.
So, let us walk down the three distinct roads Alphabet could take us on. Road number 1 is the scenario where Capex slows down. But even within a slowdown, the underlying reasons matter. Do they not?
They do. A Capex moderation is not a uniform event. We have to distinguish between an efficiency-driven moderation and a demand-driven cut. If Alphabet indicates they are slowing Capex slightly because their tensor processing units are running efficiently and high utilization is lowering compute costs, that is a specific, manageable signal. It shows discipline.
In that efficiency scenario, software companies and the hyperscalers might see their margins supported. However, merchant GPU makers and wafer fabrication equipment sectors could face pressure, while memory suppliers might see mixed results depending on their mix of products.
That is a plausible sensitivity. A different version of Road 1 is a demand or return on investment cut. If Alphabet signals they are cutting spending because enterprise bookings are soft or they're struggling to monetize AI products, that affects the broader ecosystem much more deeply. Spenders might see their growth multiples questioned, and the semiconductor supply chain would likely face downward revisions. A demand-driven cut presents headwinds across the entire sector.
That leads us to Road 2. In this scenario, Alphabet announces that spending stays elevated or even increases, but the returns and monetization continue to lag behind the investments.
This scenario introduces longer-term structural questions. If Alphabet raises their 2026 or 2027 Capex guidance without showing corresponding margin expansion or free cash flow generation, the initial market reaction could be complex. The semiconductor suppliers might see their near-term order books appear secure for another year, as the spending is technically confirmed.
But if cash conversion remains pressured for the companies buying those chips, the durability of that demand comes into question over the medium term.
Precisely. Spending without monetization eventually weakens confidence. If the software and hyperscaler valuations begin to suffer and they face persistent questions over their margins, the market starts to doubt their ability to sustain such high capital expenditures. Under Road 2, the initial suppliers might appear insulated early on, but the entire chain remains fragile to a potential spending halt later if the hyperscalers decide they cannot justify the outlays.
Which brings us to Road 3, the Goldilocks scenario, or the productive middle. This is a condition where both the software sector and the semiconductor sector can remain supported simultaneously.
It is important to view this as a condition that permits a dual rally, not as a guaranteed forecast. In the productive middle, the absolute level of Capex remains historically high. The budgets are not slashed. However, the extreme rate of growth decelerates to a bounded pace. It becomes a sustainable level of investment rather than an exponential curve.
So they are still spending billions, which provides visibility for suppliers, but they are no longer growing that spend at the same aggressive percentages year over year.
That is the idea. The absolute dollars continue to flow, but the growth rate stabilizes. Crucially, in this scenario, the existing server clusters begin to fill up with workloads, converting the backlog into recognized revenue. Cloud revenue, operating margins, and free cash flow accelerate and catch up to the depreciation curve. Both business models find support. The semiconductor companies maintain their high revenue base, and the software companies demonstrate they can generate free cash flow from their AI investments.
To evaluate which road we are on, we have to look at Alphabet's starting point. We need the concrete numbers that serve as the baseline for Wednesday's report. What did their first quarter look like?
The Q1 baseline set a high standard. Alphabet's official capital expenditure guidance for 2026 was set at $180 billion to $190 billion. Management also stated they expect 2027 Capex to rise significantly from there, which set aggressive expectations.
In the first quarter alone, their Capex was $35.7 billion. That outflow impacted their free cash flow, which came in at roughly $10.1 billion, representing a drop of about 47% year over year.
That represents the core tension between spending and cash generation. Yet, they also delivered strong top-line growth. Google Cloud revenue hit $20.0 billion, up 63%. The cloud operating margin was healthy at 32.9%. They disclosed a backlog of $462 billion, and search advertising was up 19%. Wednesday is about measuring progress against those specific numbers. Does the free cash flow decline narrow? Does the cloud margin hold? The starting line involves historic spending paired with historic revenue growth.
Let us revisit the semiconductor split we observed earlier. Why is it logically possible for memory suppliers to hold their ground even if hyperscalers moderately reduce the pace of new data center construction?
It relates to the difference between outfitting an existing server rack and outfitting a brand new clean room. High bandwidth memory and conventional DRAM are currently facing supply constraints. Producing HBM requires a disproportionate amount of DRAM wafer capacity, which naturally limits overall supply.
Furthermore, memory content per AI accelerator and per server continues to rise across the industry, independent of the number of new facilities being built.
That is correct. Additionally, companies like Micron have reported multi-year volume agreements and customer deposits. Their pricing dynamics are tied closely to utilized capacity and component density. Consequently, a modest deceleration in new fabrication plant construction can preserve memory pricing while simultaneously weighing on wafer fabrication equipment makers. Equipment orders are more directly sensitive to the rate of new cleanroom construction. That fundamental distinction helps explain why we saw Micron strength and Lam Research weakness as parallel facts on July 20th.
Before we conclude, we should touch on the broader macro and policy events surrounding the Wednesday earnings cluster. Today, Alibaba, ticker Alibaba, moved up 4.67%.
Alibaba's gains sat alongside several other China-positive facts: stabilization measures, stronger Hong Kong and Shanghai markets, and fresh attention around Quen. One session cannot isolate which mattered most. Meanwhile, U.S. policymakers remain active. The White House officially imposed additional 50% tariffs on specified Canadian goods, taking effect in 30 days. There are also reports that U.S. restrictions on advanced Chinese AI models are under deliberation in Washington. No ban or rule exists as of July 20th, but discussions are ongoing. Elsewhere in software, Oracle declined 3.98% today.
This all leads into a dense earnings and macro calendar. Wednesday gives us GE Vernova before the market, followed by Alphabet, Tesla, ServiceNow, and IBM after the close. Thursday morning brings Freeport-McMoRan and Cleveland-Cliffs, followed by Intel, Newmont, and SAP after the close. Friday includes flash PMIs and new home sales before durable goods data arrives the following Monday, July 27th. With so much data arriving shortly, how would we evaluate whether the productive middle road is actually materializing? What metrics from Alphabet would we read as constructive?
Our analytical tells are specific. First, we would look for Google Cloud revenue growth to hold at or above 60%. Second, a constructive combination involves the cloud operating margin remaining resilient around the 33 to 35% range. Third, we want to see the 2026 Capex guidance held near that $180 billion to $190 billion mark, or accompanied by clear efficiency gains if raised.
We would also look for commentary suggesting 2027 Capex will grow at a bounded pace rather than an open-ended escalation. We would want to see quantified monetization of search AI and signs that the free cash flow decline is narrowing. If Capex relative to revenue begins to peak, while supplier orders remain steady, that supports the Goldilocks condition. Conversely, a large Capex increase without revenue conversion or a demand-driven Capex cut would disprove our lens.
It is a framework for observation, and Wednesday will provide the data. It is worth noting a general principle for managing these environments. A correct long-term thesis can still produce a failed investment outcome when leverage or position size cannot survive the volatility. Survival remains a prerequisite for being proven right.
That's a wrap. If this was useful, follow or subscribe for the next one, and tell us where we're wrong. Thanks for listening.